Welcome back to the Global Business Report on Rise News. IC Asset Managers have released a strategy report on the sub-Saharan African region. It's titled Not in the Same Boat, with a specific line in the report that says sub-Saharan Africa's emerging economies may be in the same storm, but not in the same boat. So we're going to discuss that further with the author of the report, Mosope Arubayi, who's an economist with IC Asset Managers. Mosope, good to have you. Good morning.
Good morning.
Welcome to the show. So help us explain that particular, I guess, quotes of all these nations being in the same storm but not being in the same boats.
I mean, pretty much it makes reference to the fact that all these economies are going to be facing the same headwinds over the next couple of months, and we're getting headwinds from the global monetary policy normalization.
Yeah.
We've seen the trend in the U.S., which has been a bit more aggressive compared to what we've seen in England and in the euro area. So they're facing headwinds from monetary policy normalization in the global space. We've also seen the impact of the Russia-Ukraine war on commodity prices. Consumer prices have spiked significantly in a number of countries. As in Ghana is like pretty much feeling the heat at the moment. So the code basically makes reference to the fact that yes, all these emerging markets will be going through these things at the same time, but the impact on their respective economies would differ based on the initial conditions that they had, economy-wise, financial market-wise, and the likes. And we've seen that play out over the past couple of weeks.
All right, well, let's get into it. So we'll have to start off with Nigeria, obviously. And let's put up, you said Nigeria, your recommendation is, I guess, market weights. You're saying that we recommend that, let's say we can put that up on our screen here for our viewers. It says we recommend that you remain market weight Nigeria over the next 12 months due to the current multi-dimensional crises. Okay, so there's Nigeria market weight. Ghana is overweight. South Africa is overweight. But I think we have a specific quote on Nigeria. So explain the market weight outlook. And what does market weight mean, by the way?
Okay, so basically for investment, for asset allocation, you're either overweight, which means you'll be taking you'll be allocating a significant share of your portfolio to a particular asset class, a particular stock, or a particular country, as the case may be. So market weight means you're literally reducing your exposure if you were previously overweight. So you're not buying too much, you're not buying too little, you're just in the middle, not too hot, not too cold, just lukewarm, exactly.
Goldilocks.
Just so that you're not in a position where you miss out on any opportunities that may come up that you probably didn't anticipate. And you're also not overly exposed just in case things go south. Would recall that earlier in the year, JP Morgan also put out something like that, saying that the recommendation has also been downgraded to market weight from overweight. Normally, with oil trading at over $100 per barrel, you should expect that Nigeria being an oil-producing country, you'd have like bullish recommendations. However, we've seen what is going on in the fiscal space. There are reports that FAC isn't getting allocations from the NNPC because subsidies are like eating up a significant chunk of oil earnings and the likes. So the market weight recommendation comes off the fact that what are the chances that this wouldn't spiral into a crisis over the next few months if it is not properly addressed. However, you should still be in the market because there is a lack of better alternatives in the market. You pretty much have fewer options to tap into. Not so much in terms of corporate bonds. You have the equities market, which has pretty much done significantly well compared to
other equity markets around the world.
Of African equities market. So you don't have so much in terms of alternatives to fixed income assets. So yeah, there could be buckets of opportunities here and there in that space. Hence, we're saying don't be overweight, don't be overly exposed, and don't be underexposed to the market. Just be at the right spot where you can take advantage of opportunities and move out quickly if you have to backtrack on that. Okay,
well, for Ghana, you sounded more bullish on Ghana. Your recommendation for Ghana was overweight. So what's the, I guess, rationale behind that? Because Ghana is in trouble, right?
Yeah, they're in trouble.
Yeah.
However, in recent times, they're also looking for ways to get out of that trouble.
Yeah.
I know initially they were so fixated on not going to the IMF because it has like implications for the political class.
Yeah.
However, the reality is the reality. If you're not going to the IMF, what are the alternatives you have to come out of the economic crisis? I mean, the rand is down about 29%, not because the economy isn't doing well, but because the market.
Sorry, you mean the CD? Is that
the CD?
The CD,
yeah,
okay,
29%.
Yeah.
Sorry for that. Not because the economy is in shambles, unlike some other countries, but because of the structure of the financial market, where you had a situation where foreign investors were like over the years, Ghana had been like the go-to market for foreign investors that are interested in West Africa, and we saw the impact. We've seen the impact of that on the CD in recent times. So what Ghana needs at this time is how do we navigate this whole complex structure if we're not getting enough dollar earnings from our commodities. We also have a fiscal problem where investors don't want to bring in money, foreign currency, just because they want to see how we navigate, how we're able to turn the tide of a fiscal story. So at the moment, the only option they have is to go to the IMF, and we've seen them backtrack in recent times, saying, okay, they're considering it. I mean, for you to be considering it means you've probably tested everywhere else,
right,
and you've not seen a bucket of opportunity somewhere else. And we should also not forget what happened with Zambia last year when there was a power change and the prospects of getting an IMF deal became more realistic. And we saw how that impacted the Kwacha in a very short space of time, and also Kwacha-denominated assets. So I see that playing out for Ghana since they're already considering an IMF deal. They have limited options, actually. And if we expect a recession and probably would see like global easing of monetary policy, but how soon will that come? Will the economy be able to wait till that time? I doubt. So the prospects of getting an IMF deal before we even see other factors that could make Ghana a more favorable market is higher at the moment. So that's why I think it's better to get exposure to Ghanaian assets now, not when the market is already in a rally.
And the yield, as we just saw, yield on their bonds is high.
High.
Yeah,
I mean,
so the returns
cheap at the moment.
Right,
so
right.
if we have an IMF deal, you're probably going to make a killing in
Interesting.
in return.
Okay, real quick, South Africa, you're also pretty bullish on South Africa as well. Overweight, I think, was the recommendation. So why are you overweight South Africa? I
mean, SA has been like the poster child through the COVID crisis up until now. They had a mining windfall that has put them in a position where even though you have policy normalization in the global space, they probably have like sufficient buffer to withstand some of that pressure compared to the likes of Nigeria, compared to the likes of Ghana and even Egypt. So yes, we would have policy normalization, but I don't think they will be as hit as a number of other countries. They've also been doing well in terms of fiscals, overperforming revenues. I don't see that changing in the near term. So why not be bullish if they have a good macro story compared to a number of other countries.
All right, Mosope Arubayi, Economist with IC Asset Managers. Thank you so much for joining us.
Thanks for having me.
And we'll see how things turn out for those sub-Saharan African nations.